Hey guys, it's me, Josh Brown. Over the last few months, PayPal has become one of the top performing stocks in the S&P 500. This is after a disastrous fall from grace in the post-pandemic period, which ultimately led to the company appointing a new CEO, Alex Chriss, who has been highly successful as the senior vice president at Intuit prior to coming to PayPal. Joining me today to discuss the PayPal comeback and some of the more interesting stories from within his coverage universe is my friend Dan Dolev. Dan is the senior analyst at Mizuho, covering the fintech equity space. Prior to Mizuho, Dan spent time at Macquarie, Nomura, Jefferies, and Sanford Bernstein. What's up, Dan? How are we?
Hey, Josh. Thanks so much. Thank you so much for having me on today. Ready for a busy week.
Good man. PayPal has been on fire. This is a 5-year look back. I made this chart. This is not from Chart Kid Matt, so everybody give me. But we're basically showing you that in September of 2023, Alex Chriss was named as the new CEO. And you can see that this is a company that had lost probably 80% of its market cap in the 2 or 3 years leading up to that. I want to do one more chart. Now I'm showing you PayPal versus the S&P 500. This is over the last year. The stock is up almost 40% against an S&P 500 that's up about 35%. If you said, here's an item for your bingo card for 2024, Dan, PayPal is going to be beating the market, I would have said no way. But there seems to be a lot of momentum here. So I'd love to just hear from you. What do you think is the primary driver for why this stock is starting to work again?
I mean, look, and you remember when we did the last podcast, I was negative, and then I changed my mind.
Yes.
And I think that the number one reason to like it is new management. So this guy is a superstar, like you often say, like it's really all about management. This guy is a superstar, and you know what he specializes in? He specializes in what decisions to avoid. And it's been a remarkable news flow. Like every week you get like great news, like whether it's Walmart or, Pay by Bank or, all these things are coming together, or Fastlane, and we can talk about that too. Yeah. They manage expectations and they manage the news flow, and that's why the stock's working.
John, put that first chart back up. So he's a superstar, but if you look at price action, it's a delayed reaction. Nobody really seemed to think that when he became CEO. Otherwise, you would have seen a big spike on that news as opposed to what we actually saw, which is it looks like a 52-week low upon that announcement. So people people are just now starting to recognize that he's a superstar. It doesn't appear that when he came in, that was the chatter around Alex Chriss. Do I have that right?
I think you got it spot on. Like I was chatting with one of the industry executives when he was nominated, and the joke was he was like the number 5 call.
Right.
Like nobody wanted the job. Remember people were talking about Bill Reddy, who now runs Pinterest, and there was Sarah Fryer, who's now CFO of OpenAI, used to be at Square. So there were a lot of names juggling around. None of them was Alex Chriss.
Okay. So what do you think it is about him that makes him a superstar? You mentioned he's deciding the things not to do, which I like that concept. As a fellow CEO, I should probably be doing more of that than I do. But while he's deciding what not to do, meaning what frivolous, M&A deals might a prior management team have done that we're not even going to think about, it sounds like. But then as he's doing that, you're right. There's a blitzkrieg of announcements. It seems like every week PayPal has something new to tell Wall Street or tell its users.
Yeah. So for years, PayPal could not go on Amazon. And then all of a sudden you saw the news flow of Buy with Prime, right? So all of a sudden you have an opportunity to check out with PayPal on Amazon. This is like an earthquake when it comes to sort of the PayPal button, right? That's just number one. Number two in the news flow is the.
Well, how do you think he got that done?
I think he basically. I mean, that's a good. I actually didn't think about this, but as you asked this, I think they basically said, look, our button helps you with conversion. There's no need to fight that war against PayPal. Let's just collaborate. There's going to be more for everyone. Why not use us?
there are hundreds of millions of PayPal active accounts. Why
Yeah,
not have
400.
our button there?
Yeah, what's to lose, right? What's to lose in having our button there? People use it. And you know what's interesting? We live in this sort of Apple ecosystem and we're sort of siloed. I mean, there's a lot of people in the world and outside America that don't use Apple and they don't
Yeah.
trust websites. So PayPal is a huge vehicle. You always have to think about the international opportunity because there's a lot of people out there that don't trust punching in your credit card detail.
Right.
And
Onto a phone. Right.
yeah, I mean, we're 350 million people. There's a lot more
Yeah.
people in the world that don't use, kind of our ecosystems.
So you titled your research report that the Buy with Prime partnership is only a first important step in collaborating with Amazon, which would lead people to believe you think there could be more to come. What do you think are the possibilities of this relationship?
I mean, you could basically have PayPal like front and center on the Amazon checkout. I mean, just think about it. Amazon does, you know, hundreds of, billions of dollars of volume every year. And if just a
Yeah.
fraction of that goes to PayPal, right? So I think this is kind of probably a test vehicle to Amazon wants to see, how it works. And if it works well, they're just gonna integrate them into their website. And all of a sudden that spikes their most profitable business. Remember, the checkout button is 80% of profits. So it's
Right.
really important to do well on the checkout button for PayPal.
What do you think is going on with Venmo and buy with Venmo, pay with Venmo? Is that a new avenue for growth that PayPal really hasn't taken full advantage of, or is that kind of stalled out these days? What's your take?
I take this down as to kind of how he manages the news flow. I think the first step was to sort of stabilize the checkout button, show some good news there. We can talk about Fastlane too, and I think kind of maybe 2025 is going to be the year of the Venmo because there's so much opportunity, right? Venmo is sort of the de facto Alipay of the US. It's just
How
that
many
it's
how many
never,
users does Venmo have?
I think, like 60, 50, 60 million right
Just in
there.
the US?
It's just US, right? So the
Yeah.
opportunity, it's nobody outside the US knows about Venmo. So the opportunity there is to find a way to integrate Venmo and PayPal and really create a global, payment networks. And the reason it's important, it's an offensive and a defensive move at the same time. It's an offensive move because there is none. No one has this sort of like global, payment network. The defensive move is because Elon is, buying licenses to turn Twitter or X.com into a payments vehicle. So you
Yeah.
got to outrun Elon, which is pretty hard to do.
Yes. Okay. A lot of people look at that and say, well, if he's successful like he was with Tesla, we have something to worry about. If it looks more like Twitter, we have nothing to worry about.
I agree, but
Yeah.
it's been a bad bet to bet against him for the last 20 years. So
Okay.
I would take note, I would take notice when he's working on something, and I think that's what PayPal needs to do is to outrun him because they have a great brand in payments. So much easier for you to convince people to use PayPal Venmo globally than Twitter.
One of the things that's been hurting PayPal over the last couple of years is the dominance of Apple Pay within the iOS ecosystem. It's the default thing that I use for Starbucks, for example. It's just right there. It's so easy. And that's just one app. I could think of dozens of reasons why that's like an undefeated payment button. But that narrative seems to be like calming down a little bit. I don't hear as much about it. And I also noted, I think you wrote about this near field communication chip change where Apple's actually either because they feel forced to or because they want to is going to open up pay with blank as one of the options when you touch your phone to an NFC screen. Talk a little bit about why that might matter.
Yeah, and I think Apple is the perfect example of, people just making trades because they know something, right?
Yeah.
And not because it's sort of grounded in facts, right? So one fact is PayPal is actually growing in line with e-com. If you look at sort of their blended websites and their growth, I mean, PayPal's not undergrowing that. Maybe they're not gaining massive share, but all they have to do is just maintain share so that they can work on these new initiatives, right? So
Right.
that's number one. Apple is under pressure from, European regulators, US regulators to open, and we wrote about this, the NFC chip to to let every other third-party app to actually tap with it, right? So that's number two. And number three, and we'll talk about this in a second, but Apple has sort of capitulated on many things payments, right? They wanted to do buy now, pay later by themselves, and now they're giving it to a firm. So I think there's an interesting momentum here where Apple is no longer sort of the kind of most feared factor in payments because they figured out they can't really do this right.
Okay, so there is a world in which something happens where PayPal becomes the de facto secondary payment option on an Apple NFC system. I'm not saying it will happen, but like it is now a possibility more so than it was prior to that news.
I believe in it because there's a lot of young people. If they were we did some survey work. This was like 2 years ago, but we've asked people if you had a choice to actually tap with Venmo. I think a vast majority of people said, I'll try it, right? Because they already use Venmo for P2P. And if you go to the store and it's easy to do, then why not just tap with Venmo? Why not just tap with Venmo at like every, Toast restaurant?
Yeah.
I mean, there's an enormous opportunity for Venmo to start monetizing that in a way that it's never done before.
Before we move away from PayPal, tell me about Fastlane and why shareholders should be excited about this.
So this is probably the biggest opportunity right now, right? The TAM is infinite. We're talking about like, $3 trillion globally.
Fastlane is the white labeled payment for other
Correct.
people's websites.
Correct. And
Okay.
when I heard this statistic, Josh, I was shocked. 60% of volumes globally still go through like punching in your credit card detail. Doesn't go through some sort of a digital wallet or Apple Pay. So the opportunity here is to make this, and PayPal can recognize like 70% of that. They have a vault of 800 million users globally. It's like all the people that have used PayPal at some point or another in the past, and they can triangulate your information. So if you think about this, a lot of these sales just go to the trash can because it's just so cumbersome to punch in your credit card details. So if they offer,
so let's pause on that. So I'm on, I don't know, Instagram or somewhere, and I see a product that I'm interested in, and I click on it, and I slide through some pictures of the product, and then I go to say, all right, you know what, buy it, and then the next screen I'm shown is 30 fields I have to fill in.
yeah,
And I
first name,
just say, you
last
know what,
name.
I don't want it that bad. Okay.
Exactly.
All right.
That's it.
So the
You're just
opportunity
like,
is if I'm pre-filled with my PayPal account information, it's a higher likelihood I go through with the transaction.
one click, done, purchased, right? Kind of like what you do with Apple Pay, but think about it. I think we look at it from a very myopic kind of, tunnel view of, oh yeah, Apple Pay, I use it, I check out with it. But again, the world is much bigger than Apple Pay. And there's a lot of people using their desktops versus laptops and versus, phones or laptops or desktops. Like there's just a vast universe of online checkout. And a lot of it is still done manually. That's the statistics. Now, it has been proven that if you actually use the Fastlane product, you improve conversion by 10%. So you can sell 10% more if you don't just say, oh, I don't want that thing anymore. Right? The average merchant.
Is Fastlane enterprise only, or can anyone with an e-commerce site bring in that technology? Like
Anyone.
How widespread is it? Anyone?
So they're partnering. That's a great question. So they went from, like offering it to enterprise. Now they're partnering with Adyen, right? And they're partnering with pretty much everyone. So they can bring it to every SMB, right? Every person has an online store. So it's not just, Target. It's going to go trickle through down to pretty much everyone that has, selling, pet grooming stuff online, right? It's just a no-brainer in my view.
Remind me, where's your target on PayPal? And of course, guys, this is for educational purposes only. We're not making stock recommendations on podcasts or YouTube. But where do you think this stock should trade based on the fundamentals?
I mean, I got a $90 price target, but I think that PayPal is just in the first inning of the kind of revival or resurrection, right? Like it's coming back. And just before we move on to the next topic, I want to say something I think is really important. There is a very strong muscle memory in the long only community in the US. Like if you go to Boston, right? When I go marketing in Boston, I was just there last week. people remember making a lot of money owning PayPal, so it's a very easy sell.
Yeah.
Like if they just execute like they're doing now, and kind of going back to Alex being a superstar, there's a lot of people, a lot of PMs at the big long only funds are going to say, "I want to hear the story,"
Yeah.
which is very rare.
So I'm in that group. I bought the stock at 70 a couple of weeks ago when it broke into a new 52-week high. I like to buy strength in a turnaround story. So I like when there's a turnaround story, but the technicals line up with what the analysts are saying. So I got sucked in by that muscle memory too. I remember when this stock was an incredible investable security. It's been a while, but I have that
Yeah.
same muscle memory. You wrote about Visa and MasterCard recently. I know those are two of the biggest names in your coverage universe. Let's just put up a price chart on these just to set the stage. This is 1 year. The top pane is Visa. The bottom pane is MasterCard. MasterCard recently looks like it's got more momentum than Visa. It looks somewhat better. Maybe you have a take on why. But you had a fairly provocative research report titled "Could Walmart's Pay by Bank Initiative Weaken the Visa MasterCard Moat?" So set this up for us. What is the Visa MasterCard moat, and why could Walmart potentially weaken or threaten it?
Yeah. So, we have a neutral on Visa and a buy on MasterCard. I think as a pair trade, it's like the perfect pair because MasterCard is gaining share. And there's a lot of other issues that Visa has that MasterCard doesn't. We'll talk about it in a second. But back to Walmart and what's going on there. The number one issue, in my view at least, of what's hurting Visa right now is that they just run out of runway, right? I don't know if you've ever been to Aspen skiing.
No.
So they have a little airport. So the analogy here, it's like Aspen. It's a beautiful village, very prestigious, but the runway is really short. And that's how I think about that's how I think about Visa.
Okay.
And with that analogy, if you think about it, 45% of their top line growth historically has come from cash to card conversion. So the average Joe, right, is basically using more card this year than he used in year zero.
Yeah.
And in the US, we've reached per my estimates, 85 to 90% card penetration already.
Meaning anything that is still a cash transaction at this point will probably stay that way. We've had the runway of, we went from 100% cash to 90% to 80%, and now people are pretty much using their cards for anything that they might use their cards for.
Correct.
Okay.
It's like
that makes sense to me.
It's like little stuff, and some stuff that we probably shouldn't be talking about on the podcast. People are still going to be using cash for, or crypto.
Right.
But another topic, right? But for anything legitimate, there's no reason to use cash anymore, and people are not doing this. So, as evidence, in the last 2-3 quarters, they cannot outgrow personal consumption expenditure, which is the key yardstick, right? I track it. They've been growing faster. They've been growing 5 to 6 percentage points faster than PCE historically. And now that growth has kind of converged.
Now their growth, their growth is like a railroad. It's just whatever the economy's growth is, that's the boundary.
So why do you grant them a premium multiple for that? This is all I'm saying. It's a good business. It's Aspen. It's very prestigious, 70% margin, but the runway is really short. Really, really hard to land.
So why does MasterCard not have that same constraint, or do they?
In it by itself, it's the same business, right? You can't just say, pick and choose there, but they have way less exposure to the US, which is kind of like the epicenter of the storm right now in terms of that. So MasterCard is more global,
where that cash to card conversion has more room to run.
There is a little more. You could argue, we can talk about that too. You can argue like places like Germany or Japan, or there is a little bit more room, but we can talk about that too, because that's another problem that might not exist, right? It might be just like that sort of fantasy land that never exists. And two, they have less exposure to debit. Debit is sort of like the problem here. Debit is just a very expensive way for you to get your own money. And you've seen the Durbin Amendment going after debit. You're seeing now the DOJ going after, as of last week, I think 2 weeks ago, they're suing Visa for debit practices. So debit is under the gun, and you don't want to have exposure to debit. Credit, you're really offering value. I'm giving you credit. I'm taking risk. But debit, pay by bank, which was your other topic, this is what's going to like take debit down.
Okay, so let's flash that chart back. So what you're explaining here explains the discrepancy. It's not a huge discrepancy, but why MasterCard is close to a breakout and why Visa appears to have at least short-term broken down. You've got this debit regulatory overhang potentially, and you've got a higher reliance on debit versus and the United States versus MasterCard, which is more global, less debit, and therefore might have more secular growth runway. All right.
Yeah, I think when the DOJ, just like one last thing here, and the DOJ went after Visa a couple of weeks ago, they were saying Visa has like, I think something like order of magnitude of 70% market share in debit or some crazy number. I mean, don't know exactly the number, but like an outrageous number. Even if it's 60, it's a big number, and you don't want to be in that position because it attracts a lot of fire.
It sounds like Visa is going to have to become highly politically active this fall.
Okay. There's a lot of lobby. There's a lot of lobbying down in DC now.
Yeah,
I'm sure, 100%.
Okay. So pay by bank. This is the threat to debit because the consumer might prefer this to the standard of debit payments. Is that what you're saying?
Yeah, and also, so here's the technological shift that has happened over the last year that we didn't have before. So for the first time since July of last year, we have FedNow, which is quasi basically the account-to-account real-time payment rails. Like today, if I want to send you money that's not via debit, I send you like an ACH transaction. It takes 2 to 3 days to settle, and you're taking risk of not getting paid, right? Like who knows if the money's in the bank. But with FedNow, which started last July 23, and already has I think close to 900 banks signed up, including like 2 large money center banks, you can settle immediately. So you're basically taking the key competitive advantage out of debit. Think about it like that. With FedNow, there is no need to have like a middleman that helps you do a real-time transaction.
Now it's bank to bank.
It's bank to bank. And by the way, in Brazil, Pix in Brazil, which is their sort of their Alipay, went from 0% market share in 2020 to 33% transaction share last year. I mean, it's insane.
Yeah.
And debit lost about a third of that. So if you think about that 30%, 10 percentage points came from debit. And then there's other forms of payments in Brazil, like Boleto or whatever, that lost share. But debit is a direct, casualty of account to account. And that's been proven internationally. Why wouldn't it happen here? And that's what we're saying.
So Walmart, I think, is the second largest e-commerce player after Amazon. This is obviously a super important market, not just because of the market share, but the mind share. Most Americans are very comfortable with whatever Walmart offers as a payment option, and they will default to it if Walmart wants them to. What is Walmart doing, and why could that be a threat to this moat that the credit card companies have enjoyed for, it seems like 25, 30 years?
Sorry.
We got you. Don't worry.
They're I bought this at Walmart. They're the canary in the coal mine, right? You can hear me, right? Sorry about that. They're the canary in the coal mine. And by the way, and we're not talking about this today, but they work together. This is a collaboration with Fiserv, which I'm a big fan of. The huge payment giant, but I put Fiserv today with like Adyen and like the e-commerce giants. They bifurcated away. We'll talk about it next time. But what Walmart is doing help with Fiserv, they are basically going to let people pay directly from their bank account. So they're using the Now network, which is basically an intermediary network that's powered by Fiserv to help almost like dispatch transactions. Do you want to use FedNow? Do you want to use RTP, which is another thing? So Fiserv is basically sitting there in the middle, helping Walmart connect your bank directly with their register. And this is how
does a consumer physically do this? Do they pull out their ATM card, or like or is it an app on their phone?
So this is the big question. I think it's going to end up being an app that you're basically going to link your bank account. So it's all kind of like new. And I don't exactly know how they're going to do it, but my guess is it's going to be some app-based thing where you're connecting your your bank account, let's say with Plaid, and this is, by the way, why the reason Visa wanted to buy Plaid so badly in 2019 is because they knew this was coming.
Okay.
And that's why the DOJ
Plaid
stopped
is
them.
Plaid is the middleware that makes these connections between financial institutions possible.
That's my guess. I mean, the Plaid is everywhere. If you sign up for like a Coinbase account or anything, you'd basically be connecting your bank. So now that they have your bank detail, the next thing that they can do is start, sending money around, right?
Okay.
And so this is what Fiserv is planning together with Walmart. I think the big news here is that for the first time ever, we have an alternative to debit. And to your point, people trust what Walmart is doing. And I think that there's people at Walmart that are thinking very, very dearly about payments. The CFO of Walmart is the ex-CFO of PayPal, John Rainey.
Oh, I didn't know that.
So he knows, So he knows how the sausage is made, right? So he knows how to do payments, and I think that's a big competitive advantage for Walmart.
So Dan, if like 5% of transactions in store move from a swiped credit card to a pay by bank via Fiserv, that will be
billion. That's 25
right.
billion.
I was going to say that's going to be felt everywhere. That's going to be an earthquake itself.
That is a very difficult, kind of pill to swallow if you're on the other side of it. I mean, Walmart's running what, 500 billion?
Yeah.
That's getting like 25 billion a year and growing. You don't want to be on the other side of it.
Okay, that's a key. So that's a key story for anyone in this space to keep their eye on. I want to make sure we get to Affirm.
Yes.
This is a stock that you write a lot about. Your most recent piece. Let's put this chart up first. So Affirm came public and started out as one of the darlings of payments during the pandemic, when it appeared as though nobody would ever leave their house and transact in any way other than buy now, pay later via Affirm. And it was kind of a wild time for valuations. And so what I have here is both the share price, but also the drawdown. This stock has gotten off the mat since late 2023, similar to PayPal. It's still in a 78% drawdown relative to its 2021 valuation. But you talk about, this being a different business than what people think, and there being more than meets the eye in this story. So you said lower rates could help drive 30% upside to consensus volumes and 2 to 3 times to GAAP EPS. And you're talking about the multiples that you think this stock could trade at relative to other names in your coverage universe. Give us some idea of what's happening with the firm and why you think there's some sort of a re-rating coming for the stock.
Mm-hmm. I mean, you don't often. Let me start with the end. As much, I love Alex, Chris, and I love everyone, but you don't often come across a genius like Max.
Max is the founder and CEO of a firm.
Yeah, Max Levchin. I mean, co-founder of PayPal. He's in that rat pack, right, with Elon and Peter Thiel. I mean, that you don't often come up.
Former PayPal mafia, now revisiting the payment space.
Exactly. I mean, that's one of a kind opportunity to sort of bet on a founder CEO that's like really wickedly smart. So that's one thing. Now, why am I so bullish about this? And think of lower rates as lower risk. If you start thinking about this, as the rate comes
lower
down,
interest rates in the economy.
Lower interest rates in the economy is lower risk of default. And as the default risk comes down, a firm can open the spigot and just let more volumes come in. So at 5%, they can get this much volumes. At 4%, they can get this plus 30. And no one's models is actually, even though everyone knows there's going to be like 9 cuts over the next, 2 to 3 years, no one's modeling that lower risk in terms of what it does for higher volumes, because
risk of the buyer defaulting on the transaction.
Yeah, that's when you talk to Max, and I have a lot of Max time, he always says we're in the business of taking risk. Like they don't, yes, the consumer and like the brand and all that like kind of wishy-washy stuff is great, but they are in the business of taking risk. And I think that's like that's the number one thing when he wakes up in the morning. I bet you that's the number one thing he thinks about.
So playing devil's advocate, another way that some people might think of this as, the lower rates are, the worse the economy probably is. Therefore, taking more risk, while on the surface it may make sense, it might actually, from a macro standpoint, not make sense because rates are coming down for a reason. And that
Yes.
reason is there's a problem in the labor market.
Yes. And the pushback to the pushback, I
Okay.
agree, is that my 30% only assumes half is being realized. So I basically took a 50% haircut
Okay.
to what the real impact, the real number is like 60% upside to consensus. But I was like, well, let's assume there's going to be some weakness in the labor market. And you want to hear sort of the ultimate thought here, and I don't know if that's going to play out or not, but we've never been in a cycle. We've been in a 1 month cycle. And this was like, June 2020,
Right.
1 month recession. We've never been in a real cycle with this. This could be counter cyclical because
Okay.
when you're not getting credit from your bank, you might go to Max and say, can you give me credit?
Yeah.
And they have the ability, because they have millions of data points over like 15 years, they have the ability to understand, who's bluffing and who could be granted some risk. I mean, it goes the same. That's why I like Upstart.
So
Same reason.
you call this widening the credit box. So a firm is going to complete the transaction and then be owed money by this end consumer. And when they widen the credit box, what that means is they are accepting transaction volume from more consumers than they were prior because they think it's a lower risk because rates are lower.
And also giving the same consumers that are good actors more credit. So if
Okay.
you're a good actor and you bought,
Rewarding good behavior.
it's like prison,
Yeah.
right? Good behavior, you get a reward. Bad
Time
behavior,
off. Time off for good behavior.
you're going straight to the can.
So
That's exactly how it works.
So a firm's revenues are coming from gross merchandise value. All of the transactions happening utilizing a firm as the payment method. The more of those there are, obviously that don't default, the higher a firm's revenue and ultimately earnings will be. So
Yeah.
it's very straightforward.
And there's no shortage. And the best part about this, Josh, there's like the TAM is like $5 trillion. It's all credit. Like there's
It's
no shortage
everything.
of demand.
Okay.
So it's not demand, it's supply driven. Like does a firm want to give you credit or not? It's not whether or not you want credit, because everyone's going to want credit.
Okay.
And so the onus is on them to give you credit. And then take that to the next level. The OPEX, the operating expenses, are not growing as fast as revenue does. And this is what's creating enormous operating leverage in the business. We've calculated it. If they beat consensus by 30% in FY27, which is June 27, the earnings power on a GAAP basis could be as high as $3. So what is a company growing 30%? What is a company growing at 30% should trade at? So could it trade at 30 times $3? That's $90. I mean, that's not crazy. That's double of where it's trading today.
So you see it today. I guess you're comparing it to Visa, which I guess
I'm saying, look, you get a 10% grower trading at 25 times, and then you got a 30% grower. What kind of a multiple do you want to put on it? I'm like, well, maybe
Right.
you should put the same multiple at the very least. And then, I mean, my price target is 65 because, what we laid out in that note is our blue sky scenario. But in the blue sky scenario, you could, this stock could really, really, really work.
So this is like a $39 stock that you think right now should be worth 65, but longer term, if some of this leverage exists in the business model, be worth
Correct.
a lot more.
Yeah.
Last thing on a firm, who should be the most afraid of this company coming on and Max truly being a genius? Is this American Express, Discover, Visa, MasterCard, or someone else?
The banks.
The banks
that are issuing the credit.
More so than the credit cards.
I think so. Well, it's going to be the credit. The networks are going to see a drag if you go sort of pay by bank, unless if you're using the Affirm card, you're still going to get interchange, so they're not as harmed by this. But the banks, like the Chases of the world, the BofAs of the world, they're the ones extending credit. So if I'm coming in and saying I can extend credit and I'm taking share from you, but there's a super interesting chart that shows you credit volumes in Australia, where buy now, pay later started, actually inflecting so credit volumes inflected down as buy now, pay later sort of started rising. Talk about like 18, 19 before COVID. You might see the same effect here if it gets really big.
Is Australia the best way to look at a country where there is high buy now pay later penetration,
Yes.
or is there a better example?
No,
That's
Australia is
okay.
Australia is sort of the, the birthplace of buy now pay later. It's like that's where, Afterpay, which is now owned by Block Square, that's where they
Yeah.
started,
Okay.
and it's just been the longest run in Australia. So you can really see how it plays out and what it does to credit.
Okay. The last one we're going to hit today is Accenture. This is a company that you got really excited about, I think a year ago or so, based on how important companies like this are going to be to the AI build out story. So Accenture is kind of like an IT consulting company, would be the way to think about it. And there was a recent Bloomberg story that introduced a little bit of nerves into the stock, where they said Accenture to delay the bulk of promotions by 6 months on Outlook Technology Consultant on Outlook. And then you said that they would announce staff elevation, or Bloomberg said they would announce staff elevations in June. And they were citing the industry cutting jobs to weather a demand slump. But you don't think that captures the Accenture opportunity, a demand slump. So tell me the story for why you're as bullish as you are. And let's put up this chart of this is price versus market cap. This is Accenture is a gigantic company. It's a $226 billion market cap, and it's a 360 some odd dollar stock right now.
Mhm.
You could see that last summer was a really tough summer for these names. Or this past summer, I don't 100% understand why, but there's
I'll
been a
explain.
big comeback since. So tell us what's
I'll,
going
I'll
on here.
explain it to you. I'll explain it to you. So last summer, it was the perfect storm. You had two things going against you if you're betting on IT services. One, cyclical, and one, secular. Both have been refuted at this point, and that's why the
Okay.
stock's working. Let me start with the cyclical, and that's kind of the more important one. You saw that mountain. I call this the mountain, the ascent of pleasure and the descent of pain, because
Okay.
that
That's
mountain
what it
that you
looked
were
like to
going
me.
through,
Yeah.
we were going through like multiple quarters of pain as we were coming down that mountain, and all that mountain it was excess IT spend by, say, the Fortune 500 companies, because of digital transformation post COVID. Everyone's like, COVID, 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 I got to start like spending more. And then at some point they got to this glut and they're like, okay, I cannot spend more. And
Right.
then your spend starts coming down. Basically, on the receiving end of that, it's like these IT services companies whose budgets are being cut. And
Yeah.
this is what's that sort of that, kind of like downhill of pain. That's what we've been seeing through all of last year, and that's why they cut guidance. And it's not just them, by the way, it's everyone.
Yeah.
But they're the bellwether, they're the biggest one. So that's the cyclical. Now the secular, and this is what the perfect storm. You had the story, which is AI is going to take jobs away. There's a bunch of empty suits running around India. All these jobs are going away, blah blah blah. So you had like those two things hit them like two big arrows straight to the heart, and
Right.
that's why the stocks like just didn't work. And then one by one, you saw that, well, this was just cyclical. This wasn't secular, because you're seeing kind of like we track on, our team, we track, and I have a great partner here, Sean Kennedy, who does IT services with me. We track um, basically the IT spend for the S&P 500 constituents on a one by one basis. And what you're seeing now is you're seeing that the bottom it's more like, call it a soft landing. It's not going negative anymore. It sort of kind of flattens out at zero, and then it's expected to go like this.
Right.
And that's number one. And number two, to your point, AI is huge. Now they're partnering with NVIDIA, right? Just last week they announced it. And so AI is going to create more work, not less work. And
Right.
so basically those two bear cases just got completely thrown out the window, and that's why the stock's off to the races. Does that
So
does that help?
yeah, so when you see a Fortune 500 company make a big splashy announcement, we're going to do this AI initiative. There's a high likelihood that they're working with an IT services company to help implement that, and there's a very high likelihood, if they're a large company, that Accenture is the one So it's one thing to have an idea that you want to try AI. It's another thing to actually implement.
Yeah,
And so if you want to bet on implementation, Accenture would be how you would do it.
Remember when you had me on, and thanks again on the show when we initiated, and we called it the picks and shovels of software. That's of AI. I mean, someone needs to do the work. AI just doesn't do itself. Someone needs to be there and maintain it, right? So think of it as like they are the engines of AI, and that's not going to change.
ACN is pretty close to your price target. You're at 365. That's a 27 PE multiple. On it looks like $13.49 expected earnings. How would we know if there's additional upside from here? Like, what would be the thing that you'd be looking for?
You're going to see them. They just guided the year. There was a ton of anxiety. We put out a big preview saying that they have like at least 7% growth. They guided, I think, 3 to 6% constant currency. So this was like, a big sigh of relief. I think as the quarters continue to come, you're going to see them revise. What we're working now, and you talk to like Julie Sweet, she said like nothing has changed. So things are not getting better, not getting worse. If things do start getting better and our predictions on the OPEX start improving, this is going to be, an upward revision cycle in the stock. And that's what's going to, have the stock break from those levels. So I expect the odds of that being pretty high next year.
Dan, I want to thank you so much for walking us through some of the most interesting names in your coverage universe. Dan is, again, the senior analyst at Mizuho. I know you're active somewhat on LinkedIn. Are you available anywhere else where people could follow your insights besides when you make your TV appearances?
I have, thank you, and I owe that to you. You're my agent. I think I also have an X account, Dido at Dido.
All right, very cool, so Dan. Thank you so much for thank you so much for coming to hang with us, and we will definitely be checking in with you as these stories develop. Appreciate it.
Thank you. Thanks, Josh.
All right, thanks for listening, guys. We'll see you soon.